Breaking news. The regional bank stocks just experienced their worst collapse in 6 months after two of the major regional banks revealed they lost $50 million to alleged fraud. Zions Bank crashed 13%, Western Alliance plummeted 11%, and the entire regional banking sector is in freefall. But here's what's terrifying. Right now, there's $1.5 trillion in commercial real estate debt that needs to be refinanced by the end of 2025. What we saw today might just be the tip of the iceberg. Stay with me to the end because what happened on October 16th could be the beginning of a banking crisis that brings the entire system down. Welcome back to StockScope Live. And if you're watching this video, you're already ahead of 99% of investors who have no idea what just happened to the banking sector. I'm recording this immediately after the market closed on October 16th, and Wall Street is in complete panic mode. Today wasn't just another bad day for bank stocks. It was a 5-alarm fire that exposed something much deeper and more dangerous than anyone anticipated. While you were going about your day, the entire regional banking sector collapsed on revelations of massive fraud, questionable loans, and the realization that banks have absolutely no idea how bad their loan portfolios really are. I spent a lot of time analyzing the disclosures, the regulatory filings, and every analyst report I can find. And what I'm about to show you will change how you think about where you keep your money. Hey, make sure you watch till the end of the video and don't skip through because the details in this video are critical for you to understand. We're going to cover 4 of them. Obviously, the breaking news. Then we're going to talk about the cockroach theory and how it's been proven right. Then we're going to compare this to Silicon Valley Bank and the crisis before. And then we're going to tie this all together with the commercial real estate connection and the $1.5 trillion in loans that need to be renewed before the end of this year. Let me walk you through exactly what happened because the timeline is critical to understanding why this is so serious. Wednesday evening on October 15th, after market closed, Zions Bancorporation filed an 8K with the SEC. In that filing, they disclosed that their wholly owned subsidiary, California Bank and Trust in San Diego, would be taking a $60 million provision for credit losses in their third quarter earnings. But here's the kicker. $50 million of that is completely unrecoverable, gone, vanished. Zions accuses the borrowers of what they called clear misrepresentations and breaches of contract, in plain English, fraud. These weren't just loans that went bad because of a recession or poor business performance. These were loans made based on collateral and representations that may have never even existed in the first place. So Thursday morning, October 16th, before the markets even opened, Western Alliance Bancorp issued their own bombshell. They revealed they had filed a fraud lawsuit against borrowers, the same borrowers that Zions just exposed for failing to provide first position collateral. So Western Alliance tried to calm investors by saying they have enough collateral to cover their exposure. But nobody believed him, and I don't think you would have either. When the markets opened, the bloodbath began. Zion stock plunged immediately, eventually dropping 13% by the close. Western Alliance crashed 11%. But it wasn't just these two regional banks. The entire regional banking sector went into freefall. The SPDR, the S&P Regional Banking ETF, which tracks the entire sector, dropped 6.2%. Third Bancorp fell 6%. Regions Finance dropped 6%. Bank of California down 7.2%. Jefferies Financial Group, which we'll talk about in a minute, crashed 11%. Even the big banks weren't safe. Bank of America and Citigroup both fell 3.5%, despite reporting strong earnings just days earlier. The Dow Jones dropped 410 points. The S&P 500 fell 0.6%. And the fear index skyrocketed to 25, its highest level since April when Trump dropped the big bombshell on tariffs. This wasn't a normal day. This was institutional panic. Now here's where things get a little bit interesting and scary. On Tuesday, October 8th, just 8 days ago, JPMorgan Chase CEO Jamie Dimon was on an earnings call when an analyst asked him about credit conditions. Dimon gave a response that should have been front page news everywhere. He said, when you see one cockroach, there are probably more, and so everyone should be forewarned about this. Now, he was talking about the JPMorgan's own $170 million loss from Tricolor Holdings, a subprime auto lender that went bankrupt in September. We covered this in a couple of videos. Dimon called the JPMorgan exposure not our finest moment and said the bank was reassessing its risk controls. But Tricolor was just the first cockroach. Let me show you all the cockroaches that have crawled out since then. First, Third Bancorp disclosed in September it would take between $170 to $200 million in losses related to the fraud allegations on 2 unnamed loans. Later, they revealed to be connected to Tricolor. Now, setting aside the $220 to $250 million in credit loss provisions for Q3. Then, there is the First Brands Group disaster, which we covered in our last video. This auto parts manufacturer filed for bankruptcy in late September with liabilities exceeding $10 billion. Jefferies Financial Group revealed that it has $750 million in exposure to First Brands, representing 25% of its Point Bonita division's entire trade portfolio. When this news broke, Jefferies stock dropped 11% on Thursday alone. Multiple law firms have now launched securities fraud investigations against Jefferies for potentially misleading investors about their exposure. And we covered the Rainstone, the Rainstone creditor, which said that approximately $2.3 billion simply disappeared. Check out my last video. The U.S. Department of Justice also launched a criminal investigation into First Brands' collapse. Morgan Stanley Asset Management Division is demanding Jefferies buy back some of their First Brands investments, a joint venture between PNC Bank and Troist, and they're facing $1.75 billion in exposure. Bank of America disclosed it has syndicated loans to First Brands, but claims they're secured with collateral. Now let's count the cockroaches. Tricolor bankruptcy affecting JPMorgan and Fifth Third. First Brands bankruptcy affecting Jefferies, Morgan Stanley, PNC, Troist, and Bank of America. And now Zions and Western Alliance with fraud allegations on commercial mortgage loans. That's just not one cockroach. That's an infestation. Key point number 3 is, why is this different from Silicon Valley Bank? Now, I know what you're thinking. Didn't we just go through this with Silicon Valley Bank in March 2023? Is this deja vu? Well, the answer is no. This is actually more insidious and potentially more dangerous, because Silicon Valley Bank failed because of a textbook interest rate duration mismatch. They bought long-term treasury bonds when the rates were near zero, and when the Fed raised rates aggressively, those bonds lost massive value. When the depositors found out, they ran for the exits, and SVB collapsed in 42 hours, which, by the way, is the fastest bank run in American history. But here's the thing. That stuff was transparent. You could see the unrealized losses on their balance sheets. The problem was visible once people looked. But what's happening now is different. These are credit losses from fraud and misrepresentation. They're hidden until they're discovered. Zion just found out their collateral might not even exist. Fifth Third discovered their borrowers were allegedly fraudulent. Jefferies woke up one day to find $2.3 billion simply vanished from their investment. Now, Michael Green from Simplify Asset Management said it perfectly. He said, what this all speaks to is a growing concern that the quality of underwriting seems not to have been as robust as people believed. Now we're seeing credit event after credit event after credit event. The scariest part is nobody knows how deep this rabbit hole goes. Raymond James analyst wrote about Zions. He said, the optics of a large commercial loan to an allegedly fraudulent borrower from a bank that typically makes smaller loan raises a lot of questions about Zion's underwriting standards and risk management controls. Let me translate that to English. If this happened to Zion's, where else is it happening? And how many other banks made loans based on fake collateral or fraudulent representations? How many more cockroaches are hiding? Brian Mulberry from Zacks Investment Management warned, quote, should additional disclosures reveal further losses or related risks, there is a potential for the broader regional bank index or weaker institutions to face severe downward re-rating. In other words, if more banks come forward with similar problems, we could see a cascading collapse where the entire regional banking sector gets repriced based on the assumption that everyone has hidden fraud in their portfolio. Key point 4, let's connect this to the even bigger threat I've been warning about, the commercial real estate crisis. The fraud allegations at Zions and Western Alliance specifically involve loans to funds investing in distressed commercial mortgages. These are funds that buy up troubled commercial real estate loans at a discount and try to work them out. But according to the banks, these fund managers allegedly misrepresented the collateral, meaning the commercial real estate backing these loans might be worthless or already pledged to someone else. And this is happening at the absolute worst time because the office loan delinquency rates are at 10.4%. That's approaching the peak we saw during 2008. And regional banks hold 44% of their total loans in commercial real estate compared to just 13% for big banks. And there's more than 1.5 trillion in commercial real estate debt that needs to be refinanced by the end of 2025. That's not a typo. 1.5 trillion. And I'll tell you why this is terrifying. Most of these loans were made when interest rates were near zero. With rates still elevated, property owners can't refinance at affordable terms. Office buildings, hit hardest by the remote work revolution, have seen their values collapse. Office loan delinquency rates are spiking, and I think they're going to go higher than 2008 unless the Fed steps in and does something about the rates so that when these loans refinance, they're at a little bit more affordable rate. So you've got this toxic combination. Regional banks are heavily exposed to commercial real estate. Commercial real estate is deteriorating rapidly, and now we're finding out that some of the collateral banks thought they had might be fraudulent or not existent. KBW analysts noted that, quote, in the wake of high-profile bankruptcies of Tricolor and First Brands, investors are understandably vigilant for any changes in asset quality trends. In other words, investors are now assuming the worst about every regional bank's loan portfolio until proven otherwise. The Florida Atlantic University identified 59 of the 158 largest banks with dangerous commercial real estate exposure levels. These aren't tiny commercial community banks. These are substantial institutions that millions of Americans depend on for their banking needs. So, which banks should be concerned about? Well, let's talk about it real quick. Regional banks with high commercial real estate exposure are the most vulnerable. Names like, not surprising, Zion Bancorporation, Western Alliance, Valley National Bank, Synovus Bank, and all have significant commercial real estate concentrations. New York Community Bancorp has been particularly stressed with their Flagstar subsidiary showing extreme concentration levels. But it's not just about commercial real estate. Banks with high levels of uninsured deposits are also at risk because those depositors can flee quickly if they get spooked. Look for banks with more than 50% of deposit exceeding FDIC limits. Now, on the flip side, major banks, JPMorgan, Bank of America, Wells Fargo, Citigroup, are much more better positioned. They have diversified loan portfolios, stronger capital bases, and access to funding markets that smaller banks don't have. In time of crisis, there is typically a flight to quality where deposits move from smaller banks to these giants. Here's what you need to do right now. Today, not tomorrow. First, check which banks hold your deposits. If you have money at Zions, Western Alliance, Fifth Third, or any regional bank with heavy commercial real estate exposure, verify your deposits are under the $250,000 FDIC limit. Spread your money across multiple banks if necessary. Second, if you own regional bank stocks, understand that more disclosures are coming, guaranteed. Zion's reporting earnings on October 20th. That's in 4 days. Watch that earnings call closely for any additional revelations. Third, prepare for volatility. The VIX spiked over 25 today, and we could see more panic selling if additional banks disclose problems. If this analysis saved you from potential disaster, smash the subscribe button and hit the notification bell. We're going to monitor these situations, and we'll update you the second information becomes available. October 16th, 2025 will go down as the day Wall Street realized the banking sector's problems are way worse than anyone admitted. Jamie Dimon's cockroach theory just got validated in the most spectacular and terrifying way possible. The question isn't whether there are more cockroaches. The question is how many and which banks are hiding them. In every financial crisis, there are those who see it coming and position themselves accordingly, and those who get blindsided and lose everything. The fraud disclosures from Zions and Western Alliance aren't the end of the story. They are the beginning. Stay vigilant, protect your deposits, and remember, in the times of crisis, information is your most valuable asset. Thanks for watching. I'm your host, Ali, and I'll see you in the next video.